Hey guys, it's Nick, and in this video I want to talk about IPOs and how you can possibly buy some before they start trading. Now, I said in a previous video that most brokerages will not give you good IPOs unless you are a really good customer or an institutional customer or a hedge fund or something like that. And if you do find them giving you an IPO, it's usually because the institutions don't want them. It's not a very good one. And so that's why I say be wary when brokerages try to give you IPOs. Since I'm a Fidelity customer, I get a lot of emails from them always offering me IPOs and secondary offerings. Now, it's not like they're offering me Snowflake IPO or Coinbase or Facebook or something like that. These are really kind of no-name IPOs, but I'm kind of curious to see and go track those IPOs that they offered me to see how they performed. So I'm going to show what you need to do to get these IPOs to qualify for them, or what you need to do to keep getting these IPOs, how long you have to hold them, how big your account is. And more importantly, I'm going to track these IPOs that they've released year to date in 2021 and see what the kinds of gains that these IPOs had so that you can determine maybe they're a good thing to buy, maybe they're not. So I'm going to show the high water mark and where they are right now. So on the Fidelity website, they show that most IPOs, about 90% of it goes to institutional investors and the other 10% goes to retail. And even sometimes 5% of that is directed shares program, which means friends and family of the issuer. So here it says retail versus institutional split, and that IPOs are broken into two pieces of demand, institutional and retail. And that institutional investors typically receive the lion's share of any IPO allocation. And it's usually something like 90-20 split. However, the retail percentage can be higher or lower on a deal-to-deal basis. What that basically means is if it's a really good deal, the retail percentage will be lower. If it's a not so good deal, the retail percentage will probably be a little bit higher. And here, another factor is media coverage. A deal that receives a lot of media attention, involves a well-known company, is often significantly oversubscribed, which means the institutional investors put in their desired allocations, which is more than the IPO is actually offering. So institutions want to buy up the whole thing, so there will be very little left for any retail. It says this means that demand for IPO shares far outweighs supply. In such cases, your odds of receiving an allocation of shares are greatly reduced. And then the type of offering, certain IPOs such as MLPs, REITs, and business development companies can be more retail focused, so institutional investors are not vying for as large a piece of the offering. Therefore, retail investors typically have a better chance of receiving an allocation of shares in these type of IPOs. Again, if the institutional investors are not very interested in it, it means because they're not very good business ideas or good investments. And so those tend to get more pawned off on the retail investors, it seems. So let's look at what it takes to qualify to get these IPOs. So to qualify for traditional IPOs led by KKR, is reserved for brokerage customers with a minimum of $100,000 in certain assets. Other providers of traditional IPOs and other equity public offerings made through Fidelity may be reserved for brokerage customers with a minimum of $100,000 or $500,000 in certain assets. And you cannot buy IPOs on margin. You have to pay cash. It's not marginable for the first 30 days. And so here they come right out and say, how does Fidelity allocate shares? And they don't beat around the bush. Basically, each customer who participates in IPO is evaluated and ranked based on assets and revenue they have in accounts under their Social Security number. So here they say revenue is comprised of the brokerage commissions, margin interest, and mutual fund revenue generated in retail accounts of the individual Social Security number. So there it is. If you're just getting free trades and you're not generating a lot of income from Fidelity, they might put you way below somebody that's, making a lot of money for Fidelity. Now, that's at the retail level. Now, imagine at the hedge fund or institutional investor level, how much money they generate for Fidelity. They are at the top of the list for the best IPOs. And another thing is, if you think you're just going to get these IPOs and flip them for the first day gain to make money and rinse and repeat, you will get banned from participating in the IPO process if you do that. So it says you can sell your securities anytime you want, but if you sell within the first 15 calendar days from the start of trading in the secondary market, it'll affect your ability to participate in new issue IPOs. The first time you do it, they ban you for 180 days. The second time you do it, they ban you for 365 days. And the third time you sell your IPO before 15 calendar days of it trading, you get banned for life. So they want you to hold on to these things for at least 15 days. So here's a list of all their year-to-date new issue offerings, and they have relationships with Credit Suisse and KKR. KKR is private equity, so maybe they're selling some of their private equity that they want to go public. I'm not really sure, but anyway, these are who's involved in these deals, and it's usually the same names: Credit Suisse, Jefferies, JP Morgan, Citigroup, Morgan Stanley, Goldman Sachs, that kind of thing. I'm not going to look at add-on type deals because these are secondary offerings. These are stocks that are already publicly traded. I'm just going to look at only IPO deals. So I'm going to look at all of these that came IPO this year, see where their IPO price is here, the price that you would get to buy it at, and then let's see how high they went and where they currently are, and see the percentage return you would have made if you bought these things and continued to hold on to them even today. So here are the companies, here are their symbols, and these are the prices that you would have bought them from Fidelity before they started trading publicly. And this is the 52-week high, so this is the highest amount it went as a publicly traded company, and these are the current amounts. And so these are the percentage returns based on the 52-week high, and these are the percentage returns based on today's price. So from these IPOs, had you bought them at the Fidelity price and sold them at the 52-week high, you would be up as much as 185% in some cases, or basically 0%, 1%. But on average, the average of all of these is a gain of 46%, which is awesome, right? For the first 4 months of the year. However, the current price and the percentage gain at the current price is a lot lower. And so you see some of these are down 24%, up 52%, down 39%, up 36%, up 89%. And so the average of all of these, if you bought them all, your average gain would only be 7%. Not terrible, but it's not 46%. So let's take a look at the charts of these IPOs to see how they fared in the first 15 days when you would be able to sell after that 15th day and take your profit. This first one looks pretty good. Second one also looks pretty good. You would be able to get out beforehand. This one's doing not much. This one kind of went down pretty quickly. This one you would have done all right. This one not really. This is it, a biotech? This one not that great. OSCR not that great. This one pretty good. PAX, PLTK not bad. This one VEI started falling pretty quickly, but you would have been able to get out maybe here or something. So what's the verdict on these Fidelity IPOs? Is it free money that you just buy these things and sell them after 15 days and make really good percentage returns? That's hard to tell. And the reason is because I haven't actually participated in any of them. So I don't know if let's say I tried to get allocated for every single one of these IPOs, and they only allocated me on the ones that turned out to be losers and did not give me the ones that turned out to be winners, then you would have an even worse return. So really the only way to figure it out is to try to get allocations for some of the ones that you think are the strongest companies, and actually go ahead and do it and buy them and hold them for at least 15 days and then decide if you want to sell them or hold on to them. If anybody has been buying some of these Fidelity IPOs and has had good experiences with getting some of the better ones, please let me know in the comments below. I'd be interested to hear other people's opinions. And in the future, I might just start subscribing to some of these and see if I get allocations and see what happens. So guys, I hope you liked this video. If you did, hit the thumbs up, and I'll see you in the next one. Thanks for watching.